Options trading can seem complex at first glance. However, understanding the basics can open a world of opportunities for investors. Options contracts provide the right to buy or sell an underlying asset. The right to buy is called a call option. The right to sell is named a put option. Options contracts have a predetermined price, known as the strike price, and an expiration date. This flexibility allows investors to speculate on future price movements and hedge existing positions. Options trading offers several advantages over traditional stock trading. Options can provide leveraged returns, allowing investors to control a larger position with a smaller capital outlay. This leverage can amplify gains, but also magnify losses. Options also allow investors to profit in both rising and falling markets. As with any investment, understanding the intricacies of options trading is crucial for success. Watch to the end to find out how I can help you get started on your path to wealth. We'll use Monopoly money to learn with, so we can learn from mistakes. Volatility, a measure of price fluctuations, is a key factor in options trading. High volatility implies large price swings, creating potential for significant gains or losses. For options traders, volatility is a double-edged sword. High volatility increases the potential for substantial returns but also elevates the risk of significant losses. Understanding how to navigate this volatility is essential for successful options trading. Volatility is more than just a buzzword in the options market. It's a fundamental factor that directly influences the price of options contracts. Options pricing models, such as the Black-Scholes model, use volatility as a key input to determine an option's theoretical value. Higher volatility generally equates to higher option premiums. When a stock's price experiences large swings, the potential for significant price movement increases, translating into a higher price for options contracts. Conversely, low volatility tends to result in lower option premiums. Understanding this relationship between volatility and options pricing is fundamental for options traders. Volatility, while seemingly abstract, can be measured and analyzed using various statistical tools. One common measure is historical volatility, which looks at past price fluctuations to gauge how much a stock's price has moved over a specific period. Another important measure is implied volatility, derived from an option's current market price, reflecting the market's expectation of future volatility. High implied volatility suggests that the market anticipates significant price swings in the underlying asset. Traders use volatility measurements to assess potential risks and rewards. Volatility is often perceived as a threat, particularly by new options traders. However, experienced traders understand that volatility is not inherently good or bad. It's a characteristic of the market that, when understood and managed effectively, can be leveraged to one's advantage. Successful options trading involves embracing volatility, not fearing it. Traders with a deep understanding of volatility can use it to their advantage, implementing strategies that capitalize on expected price swings. A call option grants the holder the right, but not the obligation, to buy an underlying asset at a specified price, known as the strike price, on or before a certain date, the expiration date. Call options are particularly appealing to traders who believe that the price of the underlying asset will increase. Suppose you're bullish on Apple stock, currently trading at $170 per share. You decide to purchase a call option with a strike price of $180 expiring in 1 month. If Apple's price rises above the strike price of $180 before the expiration date, your call option will gain value. However, if Apple's price remains below the strike price of $180 by the expiration date, your call option will expire worthless. Call options offer a leveraged way to participate in potential upside movements of an asset. While call options capitalize on price increases, put options are designed to profit from price declines. A put option gives the holder the right, but not the obligation, to sell an underlying asset at a specified strike price on or before a certain expiration date. Imagine you're bearish on Tesla stock, currently trading at $250 per share. You purchase a put option with a strike price of $240 expiring in 1 month. If Tesla's price falls below the strike price of $240 before the expiration date, your put option will gain value. Conversely, if Tesla's price remains above the strike price of $240 by the expiration date, your put option will expire worthless. Put options offer a way to hedge against potential losses in a stock or portfolio. The price you pay for an option contract is called the premium. Option premiums are influenced by several factors, with volatility playing a significant role. Higher volatility generally leads to higher option premiums. When the market anticipates larger price swings in the underlying asset, options contracts become more expensive. Conversely, lower volatility typically results in lower option premiums. Besides volatility, other factors impacting option premiums include time to expiration, interest rates, and dividends. Understanding how these factors influence option premiums is crucial for making informed trading decisions. In volatile markets, predicting the direction of a stock's price movement can be challenging. However, volatility itself can present lucrative opportunities for options traders. Straddles and strangles are two popular options, strategies specifically designed to profit from increased volatility, regardless of which way the market moves. A straddle involves simultaneously buying both a call and a put option with the same strike price and expiration date. Similarly, a strangle involves buying both a call and a put option with the same expiration date, but with different strike prices. Both straddles and strangles are most effective when implied volatility is low, suggesting that the market underestimates the potential for future price swings. If the anticipated volatility materializes, the option's value increases, providing the trader with a profit opportunity. Iron condors are a suitable strategy for traders who believe that the market will remain range-bound, experiencing limited price fluctuations. This strategy involves selling options to collect premiums, while simultaneously establishing a risk management plan. An iron condor consists of 4 options with the same expiration date, but different strike prices. The maximum profit potential for an iron condor is limited to the net premium received from selling the options. However, the potential loss is also limited to the difference between the strike prices of the long and short options, minus the net premium received. Iron condors are a popular strategy for generating income during periods of low volatility. Covered call writing is a versatile option strategy that can be particularly useful in volatile markets, offering a way to generate income from existing stock holdings. This strategy involves selling call options on shares of stock that the trader already owns. Let's say you own 100 shares of Microsoft, purchased at $250 per share. To generate income and potentially reduce your cost basis, you could sell one covered call option with a strike price of $260 expiring in 1 month. By selling the covered call option, you receive a premium upfront. Covered call writing can be an effective way to generate income from your portfolio while mitigating some downside risk. Section 4. Protective puts, shielding against downside risk. In volatile markets, protecting your portfolio from unexpected downturns becomes paramount. Protective puts offer a way to hedge against potential losses in a stock or portfolio, acting as a form of insurance. To safeguard your investment, you could purchase a protective put option with a strike price of $115. If Amazon's price drops below $115, your put option will gain value, offsetting the losses. Protective puts provide peace of mind during periods of market uncertainty. Section 5. Volatility skew and its implications. Volatility, as we've discussed, is not constant. It fluctuates over time and can vary significantly across different strike prices and expiration dates for the same underlying asset. This phenomenon, known as volatility skew, provides valuable insights into market sentiment and potential trading opportunities. Volatility skew refers to the tendency for out-of-the-money put options to have higher implied volatility than out-of-the-money call options. This skew reflects the market's inherent fear of sharp market declines, known as tail risk. Investors are often willing to pay a premium for put options as a form of protection against significant downside moves. Understanding volatility skew can help traders identify potentially mispriced options. For instance, if a trader believes that the market is overestimating the likelihood of a significant market decline, they might sell overpriced out-of-the-money put options to collect a premium, expecting the implied volatility to contract. However, trading volatility skew requires experience and a deep understanding of options pricing models. It's essential to carefully analyze the factors driving the skew and to manage risk effectively, as unexpected market movements can lead to substantial losses. Riding the wave, a successful straddle trade on earnings volatility. Imagine a trader named Sarah who closely follows the pharmaceutical industry. She identifies a company called Biotech Solutions, or BTS, scheduled to release its quarterly earnings report in 2 weeks. Sarah decides to implement a long straddle strategy, anticipating a substantial price move. BTS stock is trading at $50 per share. She purchases one call and one put option, both with a strike price of $50. BTS announces positive results, sending the stock soaring by 20% to $60 per share. Sarah's call option now has an intrinsic value of $10 per share, resulting in a profit. Misjudging the market, a costly lesson in covered call writing. Mark holds a significant position in Global Innovations, GINV, purchased at $100 per share. Confident in a range-bound price, he sells covered call options. GINV trades at $110 per share. He sells a call option with a strike price of $115. He receives a $2 premium per share. But GINV announces a breakthrough, and the stock surges to $130. Mark must sell his shares at $115, missing out on further gains. This highlights the downside of covered call writing in volatile markets. The allure of high rewards in options trading attracts those with a higher risk appetite. The potential for substantial returns acts as a powerful magnet. Leverage allows a small investment to control a larger position. Imagine purchasing a call option expecting a price surge. If the stock price rallies, the option's value can multiply, generating impressive profits. This potential is enticing in volatile markets with dramatic price swings. Section 2. Navigating the risks. While the potential rewards in volatile options trading are enticing, it's crucial to acknowledge and mitigate the inherent risks. Options, by their nature, are time-sensitive instruments, and their value erodes as the expiration date approaches. This time decay, known as theta, can work against traders if the anticipated price move doesn't materialize within the specified time frame. Moreover, the leveraged nature of options can lead to substantial losses, exceeding the initial investment, especially in volatile markets. A sudden and unexpected price swing against a trader's position can quickly erode profits and even lead to a margin call, requiring additional funds to cover potential losses. To navigate these risks, options traders employ various risk management techniques. Setting stop-loss orders is crucial to automatically exit a trade if the price moves unfavorably, limiting potential losses. Diversifying across different underlying assets, sectors, and option strategies can also help mitigate risk by spreading potential losses. Furthermore, thorough research and analysis are paramount before entering any options trade. Understanding the factors influencing the underlying asset's price, analyzing historical volatility, and carefully evaluating potential scenarios are essential steps in making informed trading decisions. Mastering volatility, a journey of learning and adaptation. Options, trading in volatile markets presents risks and rewards. Approach with a balanced perspective, acknowledging complexities and potential downsides. It's about understanding, managing, and leveraging risk. Begin with a solid foundation in options trading principles. Explore various strategies to navigate different market conditions. Knowledge without risk management is like a ship without a rudder. Implement stop-loss orders and diversify portfolios. Mastering volatility is an ongoing process of learning and adapting. To learn more about mastering options trading, visit our website or contact us today. Be sure to like, subscribe, and comment if you have any questions. Also, share with someone who you think would benefit from making more money.